Welcome, future financial leaders. Today, we tackle the foundation of global liquidity, bank account architecture. Think of this as the plumbing of your corporate finance house. Let's get started. What is bank account architecture? It is the deliberate, strategic organization of your bank accounts across different countries, currencies, and entities. Why do we care so deeply about this? Because a flawed structure leaks money. It generates high bank fees, traps cash in remote locations, and causes severe blind spots for the CFO. How do we build a strong architecture? By aligning our accounts meticulously with the business's operating model, the local tax environment, and our internal treasury policy. In our deep dive, we learn a crucial lesson: account structures are incredibly sticky. Once your enterprise ERP and treasury systems are hard-coded to a specific banking structure, altering it requires massive IT resources and systemic downtime. Therefore, getting the architectural design right from day one is absolutely paramount to long-term financial agility and corporate success. Look at the flowchart on your screen. On the left, we have our three primary input nodes: business operating model, tax and regulatory environment, and treasury policy. These critical factors flow directly into the central hub, bank account architecture. This demonstrates that your banking setup isn't a random collection of accounts, it's a calculated, engineered design. From this central architecture node, the outputs branch to the right, delivering the three ultimate goals of a corporate treasury: optimal cash visibility, strict financial control, and maximized liquidity. This visual serves as a reminder: if any of the strategic inputs on the left are ignored during the design phase, the vital outputs on the right will inevitably fail. Now, let's explore the primary drivers behind your architecture. When designing your global accounts, you face a strategic crossroads. Do you prioritize effective flows management or efficient liquidity management? The basics dictate that you rarely achieve perfect scores in both. If you prioritize flows, you might choose a deep domestic bank that clears local supplier payments instantly. However, if you prioritize liquidity, you want fewer, centralized global banks to pool cash seamlessly across borders. Why make this choice? Because maintaining hundreds of local accounts traps cash and increases borrowing costs, while centralizing everything might delay a critical local payment due to cross-border clearing times. How do you decide? You analyze your transaction volumes versus your working capital needs. As a deep dive rule, in times of economic crisis, treasurers almost always pivot to liquidity, closing local accounts to pull all available cash to the center. This diagram illustrates the structural trade-off every treasurer faces. At the top, we have our core treasury objectives. The path splits into two distinct strategies. The left path, effective flows priority, leads to selecting local network banks and maintaining multiple local accounts. This route optimizes local payment speed, but unfortunately results in trapped cash. The right path, efficient liquidity priority, leads to global partner banks and centralized master accounts. This structure dramatically maximizes pooling and lowers borrowing costs, but sacrifices some local agility. As a modern treasurer, your goal is to map your business needs against this flowchart to find the exact right balance between these two diverging paths for your specific enterprise. Let's look at the legal and regulatory status of your accounts. Slide 3 covers resident versus non-resident accounts. What is a non-resident account? It is a bank account held in a domestic market by an entity that is legally incorporated overseas. Why is this distinction so crucial? Because central banks treat them very differently. Resident accounts enjoy standard domestic services and freedoms. Non-resident accounts, however, face strict exchange controls, rigorous reporting, and repatriation limits. How do we navigate this? Treasurers must map out the tax and regulatory rules before opening an account. For example, you might want to open a non-resident account in India for your UK parent company to collect local funds, but regulations might block automated cross-border sweeps. In our deep dive, ignoring these rules can trigger massive withholding taxes or violate thin capitalization laws. Your architecture must be legally flawless. Let's walk through this regulatory map. We start on the left with the local jurisdiction. The flow immediately hits a decision gateway: entity legal status. If your company has a locally incorporated subsidiary, you open a resident account, which flows smoothly into standard domestic regulations. However, if your foreign parent attempts to open the account, it becomes a non-resident account. Follow the red dotted lines branching off from there. They lead straight to strict exchange controls and withholding tax implications. This visual serves as a stark warning to all financial professionals. Account architecture is not just about moving money efficiently, it is about strict, uncompromising legal compliance across every border you cross. Moving to our actual structural models, we start with the most basic, decentralized architecture with local control. What is this? It's a setup where each local subsidiary owns and operates its own bank accounts within its own country. The basics are quite simple. Global headquarters writes the high-level policy, but the local teams execute the daily payments and select the local banks. Why do companies use this model? It provides maximum agility. The local team speaks the language, knows the local clearing systems intimately, and resolves supplier issues quickly. How is it built? Subsidiaries run their own localized RFPs. However, our deep dive reveals the fatal flaw of decentralization: trapped cash. Because the accounts are legally and physically isolated, Subsidiary A might be forced to borrow from a local bank at 6% interest to make payroll, while Subsidiary B has millions sitting idle earning 0%. It is highly inefficient. This diagram perfectly illustrates the siloed nature of a decentralized architecture. At the top, global headquarters pushes policy down to Subsidiary A in France and Subsidiary B in Japan. However, look closely at the bank connections. Subsidiary A interacts exclusively with its local French bank, and Subsidiary B interacts exclusively with its local Japanese bank. There is absolutely no horizontal connection between the subsidiaries or their banking partners. The cash is completely isolated in separate, impenetrable vertical silos. If Subsidiary A runs out of money, it cannot access Subsidiary B's surplus. It must go to the local bank and pay expensive borrowing rates. This visual highlights the exact inefficiency modern treasurers seek to eliminate. How do we fix those isolated silos without causing a local revolt? We use a hybrid architecture, centralized accounts with local control. What does this mean? Instead of opening accounts in every single country of operation, we domicile the accounts in major financial hubs. For example, all US dollar accounts are held in New York and all euro accounts are held in London. The basics remain the same for the end users. The local subsidiary still authorizes its own payables. Why do this? It drastically reduces your number of banking partners and pools your currencies naturally, while still allowing local managers to feel empowered. How is it executed? You open the account centrally but use robust electronic banking portals to grant strict, role-based transaction access to local teams. Deep diving, this is a brilliant transitional design. It bridges the gap between chaotic decentralization and strict centralization, preparing the corporate culture for the ultimate goal, the in-house bank. Look at the evolution in this diagram compared to the previous decentralized model. We still have Subsidiary A and Subsidiary B on the left, but the banking nodes have fundamentally changed. Instead of isolated local banks, both subsidiaries are now routing their transactions into centralized currency pools, a centralized euro account in London and a centralized USD account in New York. The dotted lines represent the local execution control. The subsidiaries still push the buttons to pay suppliers. But the solid lines represent the actual cash. The cash is now pooled by currency in global financial hubs. Both pools link to a single, global Tier 1 bank. This architecture instantly gives the global treasurer visibility and leverages massive economies of scale. We now arrive at the pinnacle of account design: treasury-controlled centralized accounts, powered by zero balance accounts or ZBAs. What is it? A fully centralized structure where global treasury owns and controls all cash. The basics: local accounts may still exist to collect customer funds, but at the end of the day, their balance is automatically swept to a master treasury account. Why do this? It guarantees 100% cash visibility and completely eliminates unnecessary external borrowing by funding deficits with internal surpluses. How is it done? Through automated banking APIs. Look at the sample JSON code on your screen. This is a configuration payload sent to a bank's API. It defines a ZBA sweep rule, taking funds from the local 01 account and sweeping them to the master treasury account. The trigger is end of day and the retained balance is strictly set to 0. This code executes flawlessly every day, transforming your treasury into a highly profitable in-house bank. Let's trace the physical movement of cash in a zero-balance account architecture. At the bottom, we have local collection account 1 and local collection account 2. Throughout the day, these accounts receive customer payments. As the business day closes, the automated sweep triggers. Follow the upward arrows. Every single dollar is sucked up into the global treasury master account at the top. The local accounts are left with a balance of zero. Now, the global treasurer commands the entire enterprise's liquidity from one single node. From this master account, the treasurer can deploy the massive, aggregated cash pool out to external financial markets to earn high-yield interest, or follow the dotted line down to fund deficit for a local disbursement account that needs cash for tomorrow's payroll. This is maximum efficiency. Let's solidify this theory with a real-time, highly impactful use case. Imagine you are the treasurer of a global aviation firm. Your airline flies to 40 different countries, collecting daily ticket revenues in 40 different local currencies. The problem, you have massive amounts of trapped cash scattered globally, and you are bleeding money on foreign exchange conversion costs. Furthermore, your biggest corporate expense is aviation fuel, and aircraft leases must be paid centrally in US dollars. How do you fix this? You completely overhaul your bank account architecture. You close the fragmented domestic resident accounts and open centralized non-resident accounts in a major hub like London or Singapore. Now, local ticket sales sweep automatically into these central accounts. You pool the currencies, net your global exposures, and fund your fuel hedging programs instantly from one centralized location. By redesigning the architecture, you save millions in FX spreads, eliminate trapped cash, and ensure your airline always has the liquidity to fly. This flowchart brings our aviation use case to life. On the far left, we have 40 local currency ticket sales occurring daily. Instead of staying trapped locally, follow the arrow representing the cross-border sweep. These funds flow directly into the middle node, non-resident accounts located in London. Because they are non-resident and centrally located, the Treasury team can immediately funnel these funds into the currency netting and pooling engine. Finally, the aggregated, converted cash flows out to the right to settle the company's massive centralized liabilities, aviation fuel hedging, and aircraft leases. This diagram proves that an elegant, centralized account architecture aligns perfectly with the physical operations and massive capital requirements of the business. We conclude by looking at how to sustain your architecture and prepare for the future. What you must realize is that account architecture is never a set-it-and-forget-it exercise. It must evolve alongside mergers, acquisitions, and regulatory shifts. The basics require you to conduct rigorous annual bank structure reviews. You must aggressively close dormant accounts and update authorized signatories. Why? Because a forgotten, dormant account is a massive fraud risk and incurs unnecessary monthly fees. How do we future-proof our setup? By leveraging the new ISO 20022 messaging standards and banking APIs for real-time, automated oversight. Deep diving into the future, the global trend is moving toward virtual account management, or VM. Instead of opening 100 physical bank accounts, you open one single physical account and create 100 virtual sub-accounts underneath it. It slashes bank fees and administrative burdens entirely. Master this, and your treasury will lead the enterprise. Thank you for joining me. I invite all learners to like this video, subscribe, and visit quicktechie.com for premium certification prep, including Q&A banks, full ebooks, audiobooks, full-length training, and exclusive interview guides. Our final diagram illustrates the maintenance lifecycle required for a world-class treasury. It begins at the top with the annual bank review. This vital process flows into identify dormant accounts. Once flagged, the action node requires you to close accounts and update signatories, which directly mitigates enterprise fraud risk. From there, the forward-looking arrow points to implement virtual accounts, VM, replacing outdated physical structures with digital efficiency. This continuous loop culminates in sustained treasury excellence. Notice the dotted line returning to the start. A great architecture requires great, continuous housekeeping. Stay vigilant, keep your structures lean, and your treasury will remain a strategic powerhouse.